Shri Gurubhyo Namaha. Hello there. Welcome back to CMA Part 2 lecture series from Global Phoenix. So in this video, we are going to talk about section E of CMA Part 2, which is investment decisions. Right. So this section has been renamed from investment decisions. This has been renamed to capital investment decisions, just to make it very clear that we are only going to talk about capital transactions. Capital transactions means basically long-term financial investments. Okay. So this is again one of the less volume areas of your syllabus, and as you can see, this is only for 10% of the overall score, which is basically 50 marks of your 500 marks paper. So there are two parts in CMA part 2 section E. There are two units. What are those two units? One is capital budgeting, another one is capital investment analysis. So let's talk about these two. Capital budget. Capital means long term, budget means you know what is a budget. So while preparing a long-term budget for an organization, what are the stages that are involved in the capital budgeting? Okay, so how do we develop the budget? How do we implement the budget? That is what is covered in the first topic. Then we look at the relevant and irrelevant cash flows. Suppose if I am evaluating whether I should invest in a particular project, whether I should launch a new product or not. So I'm going to do a projection for it for a long period of time. It's not a small amount of, it's not a small decision to take like that. Like for example, if I launch a new product, I'm going to look at the sales for the next 5 to 10 years. That's a long-term budgeting that we are going to do here. So we are going to look at the stages of the budget, capital budgeting, like planning, developing the budget, implementing the budget, all that stuff. Then we are going to look at the incremental cash flows. Incremental means what? Additional, extra. Like for example, I am already selling product A. Now I am planning to sell product B along with the product A. So while selling in order to sell the product B, what are my extra revenue that I can generate and what are the extra costs that I'm going to incur? So I'm going to look at the extra, like for example, in the same building, I'm going to sell product A and product B together. So now there is no separate rent for B. The extra additional cost is zero in terms of rent. That is what we are going to look at. Incremental, extra, additional, relevant cash flows. Then we are going to consider the tax effect of that, because you know, when you invest in a particular project, the depreciation will give you a tax relief or a tax saving on that. And similarly, you know, even if a particular product is loss making, you might want to continue that product because you can harvest those tax losses and set them off against the profits of some other branch that you are having. There are a lot of tax rules. We'll discuss in detail when we go into the lectures. But yeah, and uncertainty, like what is the difference between uncertainty and risk? In short, if I have to tell you, uncertainty means cannot measure. Risk is something that you can measure, or we can say quantify. Like for example, if I toss a coin, heads and tails, what are the chances? Sir, 50-50. Very good. So can you measure this? Are you able to calculate this? Are you able to quantify this? Yes. So it is a risk. It is not uncertainty. It's a risk. Then what is uncertainty? Suppose I am planning to start a new business. Will I make a profit or will I make a loss? If somebody is saying, sir, 50-50 chances, they are stupid. Because it depends upon the type of business, it depends upon the product, it depends upon the market, customers, competition, my knowledge about the market, knowledge about the product, marketing strategy, pricing strategies, manufacturing, vendor relationships, customer relationships. Oh my God, there are a lot of factors that need to be considered before I can say that, yes, sir, your business will be profitable, or no, sir, your business will be a loss making. So many factors to consider. That is called as uncertainty. I don't know. Then what you should do? You should gather as much information as possible. Once you start gathering more and more information, uncertainty slowly clears off and you can now start quantifying that. And you can say that Yes, sir. Based on all the research and data that we gathered and analyzed, there are 65% chances that you will make a profit, 35% chance that you are going to make a loss. So you are measuring it now. So that means it is a risk position now. So that is the difference between risk and uncertainty. Then in the second part, this is purely numerical, no theory at all, completely numerical. So here we are going to talk about capital investment, whether I should invest in a particular project or not. So we are going to use some techniques. One is called as NPV, net present value, PV of cash flows, PV of cash inflows minus PV of cash outflows, present value of cash flows. We are going to discuss that. And this is very similar to DCF technique, discounted cash flow technique. Then you have internal rate of return. Internally, what is the rate of return that the project is generating? Okay, or this is also called as the rate at which NPV becomes zero. All right. So in short, if I have to tell you, and see again, this is not the lecture, full lecture, we'll discuss there. But if the net present value is greater than zero, that means a positive NPV is there, you should accept that project. Similarly, if there is a negative NPV, you should reject that project. Then IRR means rate of return. See, if your return is equal to your cost, then break even. If return is greater than cost, profit. If return is less than cost, loss. Correct? Sir, I am incurring 10% cost and I am getting a return of 15%. Good. 15% is more than 10%. So you are making a profit of 5%. Very good. So if your IRR, rate of return, is greater than your weighted average cost of capital, cost. If your return is more than your cost, accept. If your return is less than cost, reject. That's what we are going to do there. Then payback, how much time it is going to take to get your money back from your business, to get your investment back from a business. That is called as payback. Like for example, I invested 10 lakhs in a business. Each year I'm going to get 2 lakhs. That means it is going to take 5 years to pay back my money by the business, right? The business is going to take 5 years to pay me back my money or my investment. Similarly, comparison of different analysis method. So how are we going to compare NPV, IRR and payback period? What are the advantages of one? What are the disadvantages of the other? Which is more suitable in which kind of scenarios? All that stuff will be covered in comparison. We are also going to talk about, within payback, there is some other concept called as discounted payback. So that is also there, just not covered as a separate learning objective by IMA, but yeah, that topic is also absolutely there in the syllabus. Okay, so those are your 2 units in section E, capital investment decisions of CMA part 2. This is a purely numerical I can say section. So if anybody is interested in numericals, then absolutely go ahead and start with section E of your syllabus. But remember, this is just 10% of the overall score, so don't spend too much time here. Okay, your main focus are section A and section B. Section A 20% and section B 25%. Right? Wait, did I say that correct? Sorry, section A 20%, section B 20%, section C 25%. Those itself, the first 3 sections itself cover 65% of your overall score. Then D, E and F 10, 10, 15. These are very dummy topics, very small topics. I'm not saying ignore these topics, but don't try to spend too much time on section D, section E and section F. Okay, your major attention should be on your A, B, C, which are 20, 20 and 25% of the score. Section A takes very less time because it's just ratio analysis and profitability analysis. You can complete section A faster. Section B is one of the most lengthiest sections, so try to keep it for late. Section C, again, CVP, marginal analysis and all, that is also very interesting topic and 25% weightage. So I would recommend you to pay attention, more attention to section C of your CMA part 2. Section E is relatively very easier and it's purely numerical, and once you get to understand the format of a particular problem solving, like NPV is there, what are the steps, what is the table, what is the content, once you know that, it's just crunching the numbers. It's much easier to quickly complete this particular section. Okay, So with that information, I'll be ending up this particular video. I'll see you in the next lecture. Until then, keep smiling. Take care. Bye bye.